Welcome. We are going to introduce chapter 3 in this video, so we'll get started. All right, first off, there's my favorite spot in Denver, Colorado. Of course, there are better bears that are blue, as in blue. Yes, one of my favorites. Concepts we're going to explore today: asset classes, and some of those major asset classes include stocks, bonds, real estate, and cash. We're going to touch on diversification and risk and return as well, either in this video or the next one. All right, so what are stocks? All right, stocks can be private. You can have a private corporation that only one person owns, or they can be public with thousands or even millions of shareholders, and publicly traded stocks trade on exchanges typically. Here's a picture of the New York Stock Exchange, for example. Nowadays, there's actually very few people on the New York Stock Exchange floor. Most of the trading is done with the aid of computers nowadays. Here is a stock certificate from General Motors issued back in 1955. Nowadays, we don't really see stock certificates anymore. Basically, every corporation has stopped issuing because everything's electronically done. Nowadays, you just have a brokerage statement and it shows all the different securities that you own and the like. But there is one certificate that a lot of people want to own. Yeah, that's the Walt Disney Company stock certificate. And in fact, Walt Disney Company was one of the last companies to stop issuing the certificate, but now you can get a replica. Unfortunately, it's like 200 bucks or something like this. Why do people want this? They want to frame it and put it on their nursery wall when they have small children. Yeah. So stocks, also called common stocks, we're not really going to discuss in this class a lot. Preferred stocks, they're more like bonds. But when we talk about stocks, we're really talking about what's called common stock, also called shares of stocks. Stocks and stock mutual funds basically consist of a lot of stocks, are also called equities. So you'll hear the terms stocks and equities kind of used interchangeably a lot. Well, what is a stock or a share of stock? It represents a small fraction of the ownership of a corporation. Stocks don't have a maturity date. There's no required date that you have to turn it in. For example, you can own it indefinitely. Uh, and you can sell stocks typically to either another person or on a public exchange through a brokerage firm. So what do you get from owning stock? Well, hopefully what you're trying to get first off is a payment of dividends, basically cash that's paid out from the company on a typically a quarterly basis. Not all stocks pay dividends. A lot of the times companies will keep a lot of their cash and use that cash to grow the company as opposed to paying off dividends, or they might be paying off debt or doing something else with the cash. Uh, and the other thing that you hope to get is that the stock price goes up, that the value of the corporation in the eyes of investors goes up. And so you're looking for that appreciation of value. Of course, when you own stocks, the value can also go down. Yeah. So let's take an example of this. General Electric was the largest company in the world for much of the 1990s. It was also one of the most admired companies. And Jack Welch, who was basically the CEO until late 1998, was called the manager of the century. Yeah. General Electric now has over 1 billion shares outstanding. If you own 100 shares, you own 1 divided by 109, 900, I guess it's 109 million shares outstanding. Okay. The price per share is $79.01 as of August 11th. So your shares would have been worth at that point 79.01. And in 2022, you would have received dividends paid on a quarterly basis, 8 cents per quarter. So the total you would have gotten was 32 cents per share. And if you own 100 shares, you would have gotten 32 cents. Of course, you hope that the price goes up. Unfortunately, if we look back at the history of General Electric, we look back in the 1990s, late 1990s, when it became the most valuable company in the world, but starting around early 2000, the value plummeted and continued to plummet. And in fact, the value has kind of trended downward since then. Yeah, kind of one of the reasons why. Well, General Electric sales have gone down. If you look at their revenue, oops, revenue from 2012, $144 billion of revenue. That's the amount of sales that the company had. It's gone down pretty much, all the way here through 2021, and it may be rebounding a little bit. We'll see in the next year or so. So can you lose if you own a stock in a company? Can you lose everything? Yeah, in fact, if lots of corporations file bankruptcy every day, and when bankruptcy is done, basically all the assets of a corporation are sold, and the creditors get paid first. Creditors are not stockholders. Stockholders are owners of the company. But creditors include bondholders. So if you own a bond, you're typically going to get something and some percentage of what you own. But stockholders generally don't get anything because there's nothing left at that point. Yeah, the 20 biggest bankruptcy in the U.S. history all have happened. Well, the top 8 or so have all happened here in the last 20 years or so. Lehman Brothers back in 2008, the biggest bankruptcy by far, company that was worth $691 million at some point. This is a big brokerage firm, also called an investment bank. Uh, and they got really caught up in the sales of what are called mortgage-backed securities, and they basically filed bankruptcy as a result. Big savings and loan, WorldCom, which had a big accounting scandal. General Motors filed bankruptcy in 2009, and the bondholders of General Motors actually became stockholders of that company. Stockholders who owned it back in 2009 got nothing. And then another bank, PG&E Energy, filed bankruptcy in 2019. A large part of the big fires out there and a lot of liabilities relating to that. And Enron was a big accounting scandal back in 2001. So yeah, bankruptcies happen all the time, even for big companies. There could be surprises, and bankruptcies can occur sometimes a year or even 2 years after a company is really doing well, or at least perceived to be doing really well. Yeah. Here are just some more bankruptcies, including Chrysler, Petroleum. PG&E Group also filed bankruptcy back in 2001. So a lot of names that you might recognize that. Bonds are different than stocks. With a bond, you're not owning part of the company. You are loaning money to the company. You become a creditor of the company. Yeah, kind of like saying you're the bank to a company in a way. Uh, Bondholders would typically be issued bond certificates that would show, what is the interest rate, when are you going to get paid back your money and the like. But nowadays, again, we don't have bond certificates anymore. Even U.S. savings bonds, Series E bonds, if you have parents, grandparents, they might have some of these still around. Typically, they go on for 30 years until they're turned in. And Nowadays, if you were to go out and buy Series E savings bonds, it would all be done electronically online through Treasury Direct. Yeah. Here's a City of Los Angeles waterworks bond, a type of municipal bond issued by a state or a local government. Yeah. And so with a bond, an investor loans money typically to a corporation, but it could be to the United States government. It could be a municipal bond. You're loaning it to a state, a city, a town, or something like an airport authority or a toll uh, bridge authority. So lots of different state entities that can borrow money. There's also foreign governments and also foreign corporations as well. So what are you getting when you're investing in a bond? Well, you're trying to get interest payments. You want those interest payments. Most bonds pay interest payments every 6 months. And then when the bond matures, its maturity date, you're going to get the money that you loaned back, the face value of the bond, it's called. So bondholders are creditors. And if a corporation files bankruptcy, again, bondholders as creditors receive money from the assets that are liquidated, and that's typically about 40%. Now, the range is actually quite broad. It can be 0, it can be 100%, but typically it's in the 30 to 60% range. And things I've read recently have kind of indicated that the average is around 38% somewhere. So I just say 40%. But it also varies depending on the macroeconomic environment, how bad the economy is, whether there's a demand for those assets that are being liquidated. It could vary by the type of corporation, what industry the corporation is in. So there's a lot of variances there, but the average recovery rate is around 40% or so. So bonds are issued by even WKU. WKU sold bonds back in, this is a news article from 2006 for Schneider Hall renovations in a health services building. And the net interest rate was 3.89%. And four firms bid on the bonds, and basically the underwriter became Morgan and Keegan. Keegan basically came up with the money to buy the bonds, and then it sold those bonds to a whole bunch of individual investors and banks and things like that. So let's go on and discuss asset classes. All right, again, we've discussed equities or stocks. We've discussed fixed income investments, which include bonds. I also group CDs, certificates of deposits issued by bank, as part of fixed income. And there's others out there. Mortgage-backed securities and even student loans are kind of grouped together in big bundles, and shares of that bundle are sold off to investors. But just stick with the major asset classes here. Cash is one of those, and real estate is another one. Then everything else is kind of included as an alternative asset class, and we're going to study a little bit about commodities as one of those alternative asset classes. Again, equities, basically you're investing in the stock market. All right. Fixed income investments include government bonds, corporate bonds, high yield corporate bonds, which is basically non-investment grade speculative bonds. There's actually a lot of the municipal bonds, bonds issued from countries that are called emerging markets countries, and there's even mortgage-backed securities and a whole bunch of other types of fixed income investments out there. But the four major asset classes, at least the way I define them, would be stocks, fixed income, which would include bonds, real estate, and then cash, which is basically checking, savings, money market accounts, also money market funds. Now, not everybody agrees with what the major asset classes are. All right. Some group real estate, for example, as within a whole broad category, which is called alternative investments. That also includes commodities and hedge funds, private equity, where basically a group of investors goes and buys one company, and it's no longer a publicly traded stock anymore. Venture capital, which is a type of private equity, even cryptocurrencies, which we'll discuss in class. All right. So there's the way that we classify asset classes is by looking at the characteristics of that security, of that investment. So they have different risk. We know that stocks are riskier than bonds. All right. So anytime we have more risk, we would expect a higher return. The lower the risk investment, the lower return. And that's called the risk return trade-off. Yeah. So we're going to see that concept several times in the course. All right. And so let's just discuss this. What's safer? A $10,000 bond issued by Western Kentucky University that pays 4% interest. It matures in 2029. It has a value of 10,000. Or 77 shares of Apple common stock, which is worth about 130 bucks a share as I'm recording this. And those 77 shares are worth a total of 10,000. Which is safer? Well, all right. The chance that Western Kentucky University will not pay back its bond by 2029 is really, really low, right? So investors have a lot of certainty about getting that $10,000, right? The price of that bond might fluctuate as interest rates in the marketplace change. It may be fluctuating a little bit, but pretty much people know that, hey, come 2029, I'm going to have all the interest payments. I'm going to get $400 a year, about $200 every 6 months. And I'm really, really certain to get that $10,000 back. But Apple company, wow, Apple is the largest corporation in the world, or at least in the United States right now. It's worth $2 trillion. Yeah, all the stock of Apple was worth $2 trillion, but just 6 months ago, it was worth $2.7 trillion. So the price has come down a little bit. And that risk, that big decline in price that could be seen, because you never know what the future of Apple's going to be. That risk is present there. That means you're going to need a higher rate of return or you're going to expect a higher rate of return in order to justify you investing in that. All right. So risk and reward are related. The higher the risk, the higher the return. There's all different types of risk, the price volatility, inflation is a type of risk, and just a whole bunch of unknown risk out there. Some of those are called black swans. And savings accounts are very safe, of course. Bonds, stocks are more risky. Startup companies like venture capital would be, and then cryptocurrency is probably really high risk. All right. So investing always comes with risk, and part of investing is determining how much risk do we want to take on, and can we take on certain risk, but through diversification or other means, kind of help try to minimize some of those risks while keeping the higher reward that comes with the higher risk. All right. So generally speaking, the higher the risk, the greater we expect a return. Not all risks are perfectly compensated, though. All right. And this concept is called the risk return trade-off. Yeah. Right. So when you talk about investors and talk about risk, you really don't talk about risk in terms of volatility, which is the up and down movement of prices. All right. What investors are concerned about is, am I going to lose my nest egg? Am I going to lose my investments? Am I going to meet my financial goals? I just had a conversation yesterday with one of my clients, and the big question on her mind, she's about 40 years old. She's about 20 years from retirement, and she's really concerned after kind of the market downturn that she might not be able to retire when she hits the 60. So there's a lot of different, we've talked about financial freedom. There's a lot of different levels of financial freedom. This is a kind of an interesting chart. Uh, One is just you figure out where you're at. Another is you're self-sufficient. You're paying all of your own expenses. Hey, then you've got a little bit of breathing room. You're not living paycheck to paycheck. You've got that 6-month cash reserved. And then maybe you've got no bad debt. All your high interest debt is paid off and you've got that cash reserve. And then, hey, maybe you've got some more flexibility. You could even take off a year of work because you've saved up enough money. I'm not sure that's always a good idea, but gives you some freedom to do other things. Maybe go back and invest more in your education. And then financial independence, or what I call financial freedom, is your ability to live off of their income that you're receiving, whether it's from investments or a pension or Social Security. Basically, you don't have to work anymore. And then what's interesting about this chart is it takes it to another level, abundant wealth. You have more than you need, which allows you to probably do other things with it. Yeah. So again, how much could you lose if you invest all in Apple? Well, Apple's done pretty well. 2018, what's that? 4.5 years ago to now, it's doubled in value. It did go up to 2.71 trillion as of August. Yeah, and this chart only takes it to about 2020, but you can see, hey, wow, it was just worth about 100 billion way back then. Yeah, gee, I wish I had invested a whole bunch of money in Apple back in 2000 or something. But guess what? You never know. You never know. So, yeah, you can lose everything. Apple could go out of business in 20 years. No question that it can go out of business in 20 years. It could fall away. It could be another General Electric where it loses a lot of value. All right. So how do you guard against losing all your wealth? Number one word, my favorite one word in all of investing is don't turn down a free lunch, which is diversification. Diversify, diversify, diversify. When in doubt, diversify. Diversify, diversification, my favorite word in all of investing. So things as you do the readings that you might be try to explain in your own word. What is an asset class? What are the four major asset classes? What is the return that you get from stocks? What are you getting back from stocks? What's the return that you get from bonds? And what is riskier, stock and bond, and why? And if a corporation files bankruptcy, what do stockholders typically get after all the corporation's assets are sold? And what do owners of the bonds get? And what is the typical recovery rate that bondholders get? So just some questions for you. Have a great day. We'll get on to the readings and then another video on chapter 4. Thank you.